Homegrown Bitcoin ETF provides investors with a regulated pathway into the cryptocurrency market.
When you're ready to take your investments to the next level, you might want to consider Monaco.
Hello and welcome to the Global View on this Wednesday. I'm Andrew Gagan. Good to have you with us here at ausbiz. So let's check what happened on overseas markets overnight. Political uncertainty in the EU weighing down European shares, while on Wall Street shares reversed early losses with the Nasdaq and S&P 500 again climbing to record highs ahead of tonight's inflation data and the Fed policy decision. Apple shares helped drive those indices high, with its shares closing at a record, as investors are enthused by new artificial intelligence features that have been unveiled at the company's annual developer conference. The big banks dragged the Dow lower, with JP Morgan Chase leading those losses. General Motors gained after the carmaker announced a $6 billion share buyback plan, while it also cut its annual electric vehicle production forecast. And after the close, Oracle shares rose 8% following the release of quarterly results, as it forecast revenue growth in the double digits for fiscal 25. As it sees strong demand for its AI-powered cloud services. And falling iron ore and copper prices have seen US-listed shares of Australian miners fall, with BHP down more than 3%, well, in fact, just almost 3%, and Rio also lower. Well, US Treasury yields have fallen ahead of key inflation data and a policy statement from the Fed Reserve. Tonight, yields had risen over the prior two sessions after a stronger than anticipated US jobs report last week undermined expectations for interest rate cuts this year. The fall in yields came off the back of a $39 billion auction in 10-year notes that was viewed as strong by analysts, with a well above average demand. The yield on the 10-year note fell to 4.41%. And the US dollar has hit a 4-week high, while the euro has come under pressure by the political uncertainty in the European Union, with gains by Eurosceptics in European elections and a snap French election seen as complicating the EU's attempts to deepen integration. The Aussie dollar, little changed at 66.1 US cents. Well, for more on the overnight session on Wall Street, I caught up with Howard Silverblatt from S&P Global.
AI is a major component of it within tech and NVIDIA, but it's still the Magnificent Seven. They're still outperforming everything. This year they weren't expected to do good, and they are continuing on. Literally right into this month. I mean, this month to date, they're averaging up about 4.7%. The average issue in the index is down about 0.8, 0.9%. These issues are up, so traders are still playing them. Momentum is helping to put the money in there, but it's tech and communication services that are just dominating this. She said the new highs, we've had two new highs right in a row here, yet the breadth for the last 2 days has been negative. So again, we are back to a top-heavy situation, and we're seeing investors go in there. We're seeing some volume go. We're seeing some issues. For example, Apple actually went up significantly on the AI situation. I hope that they'll be able to catch up. Yeah, they're now up year to date about 7 to 8%, but they closed at a brand new high, and they're right within that 1.2% of Microsoft, which is the largest cap in the world. So we are seeing it, but again, it's top heavy.
Yeah. So what? I know you've got a chart here, just as far as how many new closing highs we've had this year. Let's bring that up. It's quite incredible.
Yeah, 27 out of 110 days. Remember, we had an April that was down. We were talking about corrections back then. So amazing that we've been able to come back down. And even without the Magnificent Seven, the market's still up, just nowhere near that high. So we're seeing, again, the top of the market's good. We're seeing a lot of money, a little over $5 trillion, $5.08 trillion added to the S&P 500 this year alone. Again, a lot of that's paper money, but that's still wealth, and that's committing people to buy more stocks and to buy other items in there. We're still seeing consumers spend, and the government is spending like it's going out of business.
And just taking a look at the sector performance, then we'll bring that chart up as well with the S&P 500. What are the outperformers? What are the underperformers at this point, Howard?
Obviously, the tech, as everyone knows, and communications. And again, a lot of people do put those together because a lot of issues were broken away in the social media issues as well as those. But you'll notice that real estate still hasn't recovered. It's still in the red. It's done a lot better recently. It's come back up somewhat, but again, still the only sector that is expected to get worse as the year goes on. There's a lot of refinancing that's coming up at the end of the third and into the fourth quarter of this year. And these companies for real estate have two choices. They either have to sell their property, which is at a depressed level, which is not a likely scenario, or they have to refinance, which is going to be at a higher interest rate. And that's going to put the squeeze on them. We still have, especially for commercial real estate, office buildings not recovered yet, especially in the major cities. Housing has stayed up, so some of that is doing well. But again, the prices are high, but the turnover isn't as much. So again, real estate's the one that's under the most pressure. Where we are seeing some buying, though, and the question is, how far out we're going to be going on it, is healthcare. We've seen more money starting to come into to healthcare, speaking to where it might be more towards the end of the year. Again, we anticipate where earnings will go.
So, Howard, more immediately, tonight, our time, tomorrow yours, key events in first the CPI read and, of course, then the Fed decision. What are the expectations?
The easy one is the Fed, and that's that they're going to do nothing and indicate nothing. The expectations on the street is still somewhat of a coin toss that they'll reduce it in September by a quarter of a point, with a lot of people seeing that potentially a second decrease after the election in December. But again, we have to get there first. So expecting very little to be said, and that basically they'll keep all the options open, talk about reductions and time to do reductions, but not actually do anything on there. Before that, we do get the CPI, which will prime us up. CPI is expected to mostly be flat. So we've stopped some of the increases, but we're not going down quick enough, which the Fed wants to. One of the components in there that might be a little bit nervy is gasoline, which at the pump has been going down for about 7 weeks in a row now. So we would expect that to see in the core numbers. So core is flat, but oil has been decreasing. Means that some of those components have had to go up, whether they be rent or food on there, and that could be concerning. And again, the Fed will have these results before they make their decision and before the 2:30 conference call that Powell will have.
So that's Howard Silverblatt from S&P Global. Well, let's now take a broader view of the US market and beyond. Chad Padowitz joining us from Talaria Capital. Chad, good to catch up with you again. Thanks for joining us. So we've just been hearing there what we're seeing on the US market, the S&P 500 and the NASDAQ hitting another record high there. What's your view in regards particularly to market breadth or perhaps the lack of it?
Yeah, well, obviously it's quite well known that the market is being driven, the closer you are to the Magnificent Seven, NVIDIA, and, even yesterday, Apple, the better you're doing. Once you sort of go below that, the market breadth is actually very weak. We're already seeing weakness in certain cyclicals, banks. The closer you are to the economy, we're starting to see more earnings downgrades, which is impacting valuations and share prices. So, it's not a healthy market, one that's got such narrow leadership.
All right, so what you're saying, there are just a few winners, but many more losers at this point. So that's what concerns you.
Yeah, well, look, up until quite recently, there has been many winners. So you've had the tech names, the AI names specifically, but you've also had cyclical companies like banks and industrials that have done well on the back of an expectation that the economy would avert a soft landing or certainly a hard landing. Now that has, we believe, the data is not supportive of such an optimistic outcome. And we are certainly seeing certain sectors of the market become more weak more recently that are more prone to some of that weakness.
So, Chad, when you talk about the data ahead. How are you viewing likely earnings growth given some weakness we're seeing now in some of that US economic data?
Yeah, so some of the data, like for instance, the ISM, which is Institute of Supply Manufacturing, PMIs, leading economic indicators that tell you where the economy is going. Just more recently, the new orders index, basically created the most recent reading. Second time in a row, it's come in below expectations and well below 50. So that's telling you, looking forward, things are getting tougher, we see that because we are in a higher interest rate cycle, which haven't yet showed up into the real economy yet. We see that still playing out. So we actually think we're pretty early days into an earnings downgrade cycle, which is only now beginning.
What's your sort of preferred market exposure then at this point? If not the US, where would you be looking?
Yeah, well, we're a bottom-up investor, so we're looking where opportunities are at the stock level, but that also shows up, in regions as well. We find the US as an expensive market, home to very expensive companies. We see more opportunities in places like Japan, which is home to some, very high-quality companies that we're able to buy at attractive prices. Certain pharmaceutical companies that we're buying predominantly in Europe, we think are very attractive. Certainly even industrial companies in Europe, we're seeing a lot of value at the moment as well. So there are opportunities out there, but on a look forward basis, we think you need to be, less economically sensitive companies, less interest rate sensitive, and away from the most overvalued segments of the market.
Well, Chad, you talk about being bottom up in terms of stock picking. One you've got in focus at the moment is Henkel, a German company. Why are you liking this one?
Yeah, well, so Henkel, they do adhesives, about 60% of their business, industrial adhesives, as well as very big in laundry and home care. They have an excellent balance sheet. And really what it is, their share price has implied lower margins than what we think is what will occur through cycle. And they've had 2 profit upgrades just in the last couple of months. So we think things are going in the right direction. They've had some restructuring that's improved their cost base. So a combination of, under earning, but in the path getting better, very attractive valuation, excellent balance sheet, and leading positions in their main markets.
Just quickly, Chad, before we go, does that political uncertainty in Europe disturb you just as far as perhaps investing in Europe is concerned?
Yeah, look, we're at the bottom up, and most of the companies we invest in, earn their money all over the world. Obviously, there's some uncertainty with European elections happening now. Bear in mind that this calendar year is the most amount of elections in any calendar year, basically in recent history. So it's going to be, no matter which country you're in, whether it's India, Mexico, which has just had, obviously the US later. So I think elections are a source of uncertainty. But, broadly speaking, bottom-up fundamentals, and, we don't think that the ones we're looking at are going to be significantly impacted either way of which way the elections go.
Chad, thanks so much for joining us from Talaria Capital.
Thank you. Bye-bye.
Check of where we're likely to get going at the open, just a couple of minutes away, and we are heading for another lower start off the back, of course, a very negative session yesterday. Stay with us, the open is just around the corner.